With retirement reforms looking set to challenge the country, more and more decision makers are beginning to take the reform initiatives very seriously. Take a look at this space now with Mike Estment, who is CEO of NFB. Hi, Mike.
Hello there.
It's a big, complex subject, and there's been talk of reform for a long time. And every now and then we have to try and break it down into common sense language and layman's terms, just to say why it's important. And perhaps we could start with what the situation is at the moment and why change is required.
I think that what often happens is that legislation is complex, and to try and make everything homogenous, to make one set of rules count for everybody, is the trend that the current government have been in play with for going on 15, 16 years of active involvement, and they've done a hang of a lot of in progressing matters. What we now have to do is we now have to take things like pension funds, where you limit it to taking 1/3 of your funds out at maturity or at retirement, whilst in a provident fund you could take the whole lot out. You'd pay a bit of tax on it, but you could take the whole lot out. That anti-selects against the rights of employees who naively went to a firm that offered a pension fund. So really it's about levelling the playing fields. The other thing that's of very great significance is that the way that assets are treated from a tax point of view on the way into these funds, whilst they're in these funds, and then again in retirement, once you actually get to need and to use those funds.
Let's just talk about that taxation, because obviously there's an incentive and a disincentive when it comes to tax, always. And retirement funds, you want to get the best deal. What is the principle that they are applying or that they want to change in terms of when you get the money, and then, in other words, when you're paid, you're taxed, but if you put it into retirement annuities, for example, you get a tax concession. But then later down the line, you pay. How does it work?
Okay, so basically the rule is you're going to pay tax on one end or the other. If you get a tax break on the way in, you're going to get a tax on the way out. So in a retirement asset, where either your company or you get a deduction, you're going to pay tax when you get to realize the investment growth, the portfolio later. In the example of an endowment or a unit trust, you might invest, you will invest capital, which is after-tax money, into the endowment or unit trust, but when you take it out at the tail end, you have capital, which is tax efficient. There is, however, a very, very important tax issue in play here, David, and that is that in the portfolio of a retirement annuity, a pension or provident fund, even a preservation fund, inside that portfolio there are no taxes deducted at present. And I use that at present because there's a caveat there, is that in a unit trust or an endowment there are tax, or if you invested in direct shares, you pay capital gains tax on gains when realized. You pay dividend withholding tax, which has been an issue of great significance in this last budget. The level to which it was increased from 10 to 15% was a significant change. People don't quite necessarily realize that, but it's a very important change. So 15% of your dividend disappears now when it used to be 10.
And this was the shift from secondary tax on companies, which put the tax onto the dividend receiver,
exactly,
as opposed to the dividend payer.
Exactly that. So kind of common cause in the market was that 10% STC, secondary tax on companies, would drop, replaced by a 10% dividend withholding tax.
In other words,
and we were shocked.
You wouldn't get the money if the company was taxed. You wouldn't get the money. You get it, then you pay it. But in fact, you're paying more than before.
Exactly that.
Right.
So in a retirement asset, there is no tax, and therefore, whilst there are liquidity limitations in retirement investments, you have to take careful consideration of that in advising someone to go take your endowments and put it into an RA. Wouldn't be good advice without understanding the landscape of liquidity and the constraints that comes with. But there is a significant tax saving inside of retirement assets which does not exist in unit trusts.
So clearly that's where people should be. Anti-selection, that term, it sounds like an industry jargon word. What does it mean?
Well, anti-selection just means that you can't have different sets of rules. And the context of that point that was made earlier was that if you happen to be an employee that goes into my business and I happen to have a pension fund, or you go and take employment at CNBC, which has a provident fund, the proceeds and your accessibility to those proceeds could be very different. In that way, your employer, in a funny way, could be anti-selecting against you. The system allows for that, and they're trying to standardize that.
So you've got to be very careful, and I think a lot of people still do as they did in the old days. They assume that there's an amount taken off and they'll get it at the end and they don't have to think about it.
Yeah, those rules have changed radically, David, and what's happened there is that in the old days, You'd get a defined pension, a defined benefit. That's changed to defined contribution. And really what that means is that more and more onus is on the investor and their advisors to formulate a plan which will suit your needs. There's no more big daddy. There's no more company that wants to take that risk on its balance sheet. They've pushed that to you.
What about, you choose a particular vehicle and then you find down the line the rules are changed and you can't go backwards. So for example, tax, the tax changes and you say, well, I've worked it all out and I'm taking that particular route in that particular kind of fund because the tax is more favorable to me. I might lose a bit on the investment return or something, and then the game changes.
It's a very good question. It's more in depth than this couple of minute interview can possibly hope to touch with, but there is that risk. That risk needs to be very carefully considered. They are, as Treasury and SARS are re-looking at what we call the four-fund approach, which is the way that life companies manage monies. They have their own funds, they have retirement funds, they have individual taxed funds and then untaxed funds. They're re-looking at that again because there are arbitrage risks and opportunities that some might be taking advantage of, and unfairly so, to the cost of others. So that's being reviewed as we speak. This is not new. It's not going to be something that happens overnight. But what's interesting is that the government have also been extremely fair, broadly speaking, in not retrospectively taking away rights. And even if one reads the most recent budget where they talk about changing these pension rules, is they've said we need careful consideration from industry and all participants to make sure that we don't anti-select and compromise vested rights by changing a rule going forward.
Of course, tax generally, I mean, government is always looking for more revenue, and it's so tempting for government. There's this massive pile of retirement money, and the way some people speak, it's almost like it's just sitting there waiting to use, whether it's on infrastructure or to all sorts of things. But you've got to be careful. This is people's retirement money. This is not the government's money.
Well, that's a very, very important and very relevant point, and that is that the sort of the gatekeepers of the sovereignty of those funds are always going to be concerned about it being a sort of a cheap shot, a one-stop shop, a place you can get massive amounts of revenue to a fiscus that's always going to be chasing fiscal pressure.
Capital gains tax, tell us what that means.
Well, capital gains tax clearly is something which is levied either on the realization, CGT, the actual events are sale or surrender of an asset, a sale of a home, for instance, a capital asset that will appreciate in value. It's again a normalizing tax where historically, if you were wealthy in South Africa, you'd probably be able to hide your returns in the form of capital gains. It's to flatten and to level the playing fields once again, which is a great job that SARS have done. Not so nice for the ultra wealthy because that's where they make their money and they have lost the arbitrage of that. But capital gains tax has been increased very materially, up from 10 to 13.3% for individuals, as high as over 27% for an Inter Vivos trust. So that's pretty high, and it's something that must be considered in allocating money to different assets.
What's the question that someone, let's say reasonably high net worth, what are the one or two key questions they've got to ask when they're getting advice?
Well, I think that it's not so much the key questions, it's understanding the full landscape. So it's not just about which fund you choose or which asset class you choose.
Because a lot of people think which fund gives the best returns.
Sure, and that could be who spends the most money on advertising. And history isn't a forecaster of the future, as is well sort of hackneyed. So it's about saying, do I have someone that understands the big picture? Am I taking all things into consideration? And probably the most important thing is saying, what do I want to end up looking like? What are my needs going to be? And then you've got a target, and then you set off to either you work backwards from there.